Welcome to the introductory lecture to the course Private Equity and Leverage Buyouts. Private equity involves a wide range of investment opportunities from venture capital to buyouts. The methods of valuation used to analyze private equity investments depend on the maturity of the company and the extent of financial information available to forecast company, industry, and macro trends. This course focuses on the valuation of late-stage companies with a particular emphasis on leverage buyouts. In addition to leverage buyouts, late-stage investments can arise into situations involving grown equity, turnarounds, mezzanine investments, and distressed debt. In contrast to venture capital, where firms are typically at an early stage of development, late-stage investments involve more established businesses that have an ability to take on higher levels of leverage to increase investors' returns. A leverage buyout is simply the purchase of a firm by an outside individual, another firm, or the incumbent management using large amounts of debt to finance the purchase. Most often, leverage buyouts are undertaken by private equity firms that specialize in these transactions. Some examples of these firms are Blackstone, the Carlyle Group, Bain Capital, KKR, and TPG. Private equity firms that specialize in leverage buyouts are often referred to as sponsors because they in effect sponsor or propose the deal. Unlike strategic buyers who often have assets or expertise to combine with the target firm, sponsors are typically financial buyers whose expertise lies in arranging the financing and incentives for management to perform in a highly leveraged transaction. That said, sponsors must also have a keen eye to identify opportunities for operating improvements. There are three value drivers in leverage buyouts, namely the financial leverage or deleverage, the growth in EBITDA through operational performance, and the multiple arbitrage. In the following slides, I will briefly describe them. However, we will analyze them in depth at both qualitative and quantitative level when we develop the teaching case at the end of the course. For a given enterprise value, as debt is repaid, equity value increases. In a highly leveraged company, a relatively small increase in the company's enterprise value can lead to a substantial increase in the value of its equity. High leverage, however, is a double-edged sword, and a relatively small decline in enterprise value can also severely reduce the value of equity. Moreover, high interest charges can increase the risk of default by the company. Another benefit of leverage is that interest on debt is tax deductible, and due to this tax subsidy, the after-tax cost of debt is generally lower than the cost of equity. As a result, provided the firm has sufficient capacity to service debt, increasing a company's leverage should reduce its cost of capital. The second value driver is the growth in the earnings before interest, taxes, depreciation, and amortization through operational improvements. Leverage buyouts transactions push firms to operate with more focused strategic goals and to achieve better results for shareholders. At the heart of a leverage buyout are strong managerial incentives created through equity participation and the discipline of high debt service. Operating improvements and margin expansion arise from large interest and principal payments that discipline management to improve sales, drive down costs, and control capital expenditures to a greater extent than under the pre-leverage buyout debt structure. Leverage buyouts are structured to give managers substantial incentives to increase EBITDA and the value of the business. management is initially required to purchase or is granted a meaningful portion of the equity. For United States buyouts, Kaplan and Stromberg found the CEO receives a median of 5.4% of the equity, stock and options, and the management team received 17% of the equity. Effective incentives require managers to bear risk, and therefore a sizable portion of their wealth must depend on the firm's performance. Multiple arbitrage is the practice of increasing the value of a company without having made any operational improvements to it. In other words, you are arbitraging the multiple at which the company is bought and sold. Private equity funds typically have a 10-year life, so sponsors ideally seek to invest and exit a target company within that time frame. Purchasing price multiples, or PPMs, are based on prevailing market conditions at the time of exit. And while sponsors can to some extent control the timing of exit, they have less control over the multiple received once the decision to exit is made. Apart from the exit multiple, the time to exit can also have an important influence on returns. Kaplan and Stromberg find that an exit occurs for 12% of buyouts within 2 years of deal closing, for 42% of buyouts within 5 years, and for 76% of buyouts within 10 years. Their results imply that 24% of buyouts fail to achieve an exit after 10 years, which makes it unlikely that an exit will ever occur. The course is structured in 4 sections. In the first one, we will make a theoretical introduction to private equity firms. We will explain its legal and organizational structures, its compensation mechanism, its fundraising process. Also, we will briefly describe the private equity investment process, which will serve as an introduction for the next unit. In the second section, we will explain the different stages of private equity investment process, namely the origination of investment opportunities, the evaluation of business plans and management teams, the different valuation methods used in private equity transactions, the deal structuring, the management of the investment portfolio, and the different investment exit mechanisms. In the third section, we will describe the background context of a real-life case, the leverage buyout of DuPont's coatings division. Furthermore, we will discuss a qualitative analysis of the transaction, illustrating the value drivers and highlighting the benefits and risks for the potential buyers. In the fourth section is probably the most interesting one, and in this section we will carry out the evaluation of DuPont's coatings divisions through the adjusted present value model. Firstly, we will construct a base model using the net present value. Secondly, we will illustrate 2 of the value drivers in leverage buyout transactions, namely the growth in EBITDA and multiple arbitrage. Then we will make a theoretical introduction to the adjusted present value, explaining its advantages over the net present value approach in leverage buyouts scenarios. After that, we will illustrate the third value driver of leverage buyout transactions, and that is the financial leverage with an adjusted present value model. Next, we will illustrate the difference between the enterprise value and the expected return of the private equity fund. And finally, we will estimate the minimum acceptable bid that DuPont's CEO should accept if she decides to sell the coatings division. As you can see, this is going to be a really interesting and comprehensive course that I'm pretty sure will add a lot of value to your career. You will have access to the videos, assessments, and the Excel model that we will develop step by step in the videos. If you have not registered yet, I invite you to do it, and I hope to see you in the course. Thanks for your attention.